Hello and welcome back to Game of Trades, your #1 channel for videos on the stock market and cryptocurrencies. This video is going to be focused on the S&P 500 that we believe is currently in a end of cycle correction. And I'm referring to the boom and bust cycle, and this chart represents that very, very beautifully. You have aggressive returns at the beginning, a period of steady trends, and then you have a reacceleration. And this is the part of the cycle where you can have a lot more volatility, so a lot more dips like this, but returns are often massive. They're often bigger. If you're able to take advantage of that volatility, the returns are larger than what you had throughout the entire bull run. And we've often given the example of 2002 to 2007 that clearly on a smaller scale followed a similar structure with an aggressive move up at the beginning, a steady trend, and then a breakout with massive returns on that final move up to the cycle top. Now, if you're interested in following these crazy markets with us, make sure to click on that subscribe button. If you enjoy this video, do not forget to smash the like button. And now without further ado, let's get right into it. Now, the first chart that I want to show you here is the net percentage of domestic banks tightening standards. And what this chart shows you is how much banks, domestic banks, are tightening, how easy loan conditions are. And this is such an important chart to look at because this is basically telling you how easy it is for people and businesses to take out loans. And we know that our economy, our entire system is structured based on debt, based on credit, based on loans. That's why we have boom and bust cycles, because of the way credit works. When it's easy to get loans, that creates a boom because people take on debt and they buy a lot of stuff, and that creates growth. And then when you have monetary tightening, then the dominoes begin to fall in the other direction and you get a recession. And then the cycle just repeats. And you can see that on this chart here. Look at this. This was leading up to the 2000 recession. Lending standards gradually became tighter and tighter. In 2007, here, the great financial crisis, same thing. Lending standards became tighter and tighter. Now, COVID is not a typical recession because we had a pandemic and central banks stepped in right before we really had a recession and brought those lending standards back into easy conditions very, very quickly in 2020. Now, you can see where we are here. We're currently still in that easy part, right? This is the zero line. When you're under that zero line, it's easy. And when you're above that zero line, it's tight. And what I wanted to do is compare that with the stock market performance. So I put up the Wilshire 5000 market cap index, right? This is basically the stock market, but I put it in a year-on-year return, so that we can actually have something that's comparable to the tightening standards. So when that red line is above the zero line, that's when you have good stock market performance. When it's below that zero line, that means you're in a market that's going down. That's a bear market. And you can see what I wanted to show on this chart is that when lending standards are easy, so that blue line is under the zero line, that's when you typically have a stock market that's performing well. You have that red line above the zero line. That was the case in the 90s here. That was the case in the early 2000s here. Easy monetary conditions, strong stock market. Same thing between 2010 and 2015, easy conditions, strong stock market, and so on and so forth. And of course, it works the other way around. When you have that blue line above the zero line, that's when you can expect some drawdowns in the stock market. It's a pretty fascinating indicator and definitely something to watch out for. So seeing where we are right now on this indicator, that reassures me. It tells me that we're still in pretty easy conditions, that domestic banks have not really tightened their lending conditions. And that's when you can typically see positive stock market growth. Now, I wanted to show you another interesting piece of data that really has nothing to do with lending standards. We just talked about the macro environment. We just talked about positive macro force for the stock market. Here, I want to show you sentiment And this is the Smart Money, Dumb Money Confidence Index from Sentiment Trader that's showing us a historical spread between smart money here in blue and the dumb money here in red. And what this indicator is based on is a variety of different indicators. It's based on put call and open interest ratios, commercial hedger positions, index futures, stocks and bonds. So it's an arbitrary indicator that measures the type of money that's in the market right now. And what's fascinating is that we've had a stronger smart money reading than at the very bottom of the COVID-19 crash. That is just fascinating right here. So let me remove the dumb money off this chart and we can zoom out a little bit and see what's going on. We'll say throughout the last 20 years, right? Taking into account the two bear markets here, you can see we've only had a handful of these super high readings in the smart money. And you can see every time you have this spike here, every time you have a big spike in this smart money index, it corresponds to a local bottom. Without fail, all of these spikes correspond to local bottoms. Now, you're probably already looking at this reading from 2008 and thinking, all right, well, you had the smart money in at the very top of the financial crisis. But if we zoom in here and check it out, even during bear market, this is a superb bottom indicator in the market here. This was 2001, right before a massive bear market rally. And here you had a pretty high reading here, but it was at the bottom of a correction. And actually from that bottom, the market rallied back to the all-time high for a 15% run. Right? So that's non-negligible here. Even if you end up exiting at the top, this is 2 years worth of annual return on the SP 500. Now I want to take a look at one more chart here, and this is just absolutely fascinating. This is the percentage of stocks above their 200-day moving average on the NASDAQ 100. So this is the market breadth of the NASDAQ 100, the technology index. And you can see right here, we hit 20%. We hit 20% of stocks that are above their 200-day moving average on the NASDAQ 100. And you can see we've only hit that a handful of times in the NASDAQ 100's 10-year price history here. In fact, I'm going to put up vertical lines every time the index, this indicator hits 20%, right? Let me quickly go through and do this. And then we can actually put up the index on top of this chart and you can see what these vertical lines correspond to. All correspond to significant bottoms. Now, just as a reminder, if you go back to the articles and videos that we were posting on gameoftrades.net back in early January, we were talking about this exact indicator. We were looking at the number of stocks above their 200-day moving average, both on the SP 500 and on the NASDAQ 100. And we were paying attention to the weakening breadth. We had the market rally, but the breadth was degrading. And that was telling us that only a handful of stocks were actually participating in this run. And that's usually the moment to start looking for downside. Now, we've made mistakes before, but throughout this entire massive correction that we've had on the stock market, we hopefully prevented too much damage from occurring because of the fact that we were looking at this indicator that we're now looking at for the exact opposite signal. You know, this is, after all, the entire goal of the service that we have at gameoftrades.net. We try to give you guys day after day, week after week, the highest quality information, data, and research possible, and hopefully, you know, stay on the right side of the market as much as we can and keep you guys updated every step of the way. I do think that this market is going to be exceptionally difficult to navigate over the next few weeks. I think there's still going to be a lot of volatility. But as I said at the beginning of the video, in our opinion, from the research that we've made, this volatility can be taken advantage of for some exceptional market returns. Of course, we'll be doing our best to update you guys on exactly what we're watching out for and the opportunities that we see on the market every step of the way. If you're interested in having access to these live updates on the market, notifications, trade ideas, and investment opportunities that we see on the market, make sure to go and check out gameoftrades.net. So that's about all I wanted to cover in this episode. I hope you guys enjoyed. If you did, make sure to smash that like button as hard as you can. And of course, subscribe if you haven't already. Now, in the meantime, I wish you good luck on your trading and see you next time.